Now, more characteristics. We're going to work backwards here now. We're going to go from, we talked about we started with the uptrend, then we talked about the base, and then we got into the pivot point on the right side. We're going to actually go backwards a bit now and start to look within the base. And what are some of the characteristics that we want to see, and some of the tip-offs that this stock may be under accumulation with institutions, and that it's a stock that we might want to consider, and also to start to ascertain and gauge the quality of the base. So when you finally see these bases and you're getting that tightness on the right side, you want to grade the base. You're looking at, after a while, you're going to know, wow, this is a pair of aces. I mean, this is like a hand that I got to push, a lot of chips on. Or you're going to see another one, you're going to say, okay, this is, this might be a pair of tens. It's not the greatest setup, doesn't have all the characteristics, but it's good enough to play, and maybe you take a smaller position. So there's some of the things that you want to look for, and one of the keys is to look for institutional demand. And Dave, I want to talk about, and have you talk about, when when we shake out some of these lows and we come back through those lows and we're coming up that right side, why we want to see big demand coming up the right side.
Well, because you want to offset the selling that was going on the left side. And the shakeout is very important, because what you've just done is you've gone under a priced area, and that looks like that 2 months of price, price of pattern, and you come in and you drop below it. And so you usually shake out a lot of investors that bought at higher prices. But if you can come back up and through that, especially on big volume, that's telling you shook out weak holders, and now you've got some institutional demand coming back in, and that should set that stock off, for a really nice run.
Yeah, and you see this over and over. Take a look at right here in MGA. Look it up the right side. You shake out that low, and then you just come ripping back. One of the keys that you know that it was a shakeout, and you've wrung out, part of wringing out that towel. This is one of the twists within those several twists, or the contractions, is coming off the lows after you undercut, that you come ripping back, and that shows that institutions are coming in there. They have an appetite. And now this isn't ready to buy here. You're not going to buy coming. You're not trying to time this. This is an observation. This is something that you want to see within the base. You're actually looking to buy higher than this, and waiting for it to build that right side. But these are some of the characteristics you're going to want to see, and you're going to see it in virtually every stock that makes a big move. You're going to see some type of previous institutional accumulation, some big demand. You can see right here, volume spike, comes up that right side, and then you start getting that right side development, and you start tightening up and setting up for that move. This is a stock, Elan, that I actually bought. This was coming off the bear market in 1990, and what caught my attention is it came ripping back right here. It started tightening up, and I was watching it right in here, and then over a couple of days it got super tight. If you come down, you can see the volume came way down. This was in January 91, and as we talked about this before, as we went to war right on, I think, January 15th it was, the market took off, and stocks just started breaking out of bases all over the place. And this is one of them that came out and was a key leader coming out of this base in this next bull market in 1991. Sometimes you'll get this institutional accumulation will happen on the left side of the base, and it'll definitely be way too early. You won't want to buy the stock. This is where you can run up on earnings, or in this case, you had company issued guidance. The company raised guidance. This was the Cirrus Logic. So I was looking at it over here, but when I was looking at the stock setting up, I took mental note of the fact that right here you had a nice big move, right, on the guidance. And now the stock actually came in. There was a general market correction right here. So that's fine. But the stock was able to set up. And at that time, I hadn't bought the cheat area, but it actually had a little buy point here and then a buy point right here.
The other thing about seeing positive price action in the months before, I even look back years. I go to a monthly chart and I actually see if the stock has an ability to run at some point in its history. And that just gives you an indication that, hey, this might be a company that has the right management, that have the right products, that are innovating, that yes, they had a move 3 years ago and it went up, 2 or 3, 4 times. There's something within that company that can create this move again. And I love to see that and see the history of a stock.
Yeah, and I think it's important to point out again that we're looking for continuation patterns. We're looking for a continuation of an already existing trend. Some people find that strange, that we want to buy a stock that's already up 300 or 400%. Or in some cases, I bought stocks that are up tenfold, and then they went up fivefold from there or 20-fold from there. So we're looking for a continuation because we want to see that institutions are already in the name, it's in an uptrend, and we've got that inertia. Let's take a look at another one here, AMSC. Like I said before, we're going to go back and look at some of the names that we already looked at. And maybe we looked at in the stage 2 uptrend. We looked at the bases. We may even looked at the fundamentals, and keep adding the information to show you all the things that we're looking at within this stock setup. So on this stock, again, if you were looking at this tightening up on the right side, you would note, look at this big move up this left side here. And now we consolidate, and now we're set up for a continuation there. And when that supply stops coming to market, and those short-term holders that are in this volatility are weeded out, you've got some big institutional sponsorship right here. So this stock, they could be coming back into the name, and that's exactly what happened. Let's see here. Here's some more recent setups. Here's Workday, of course, WDAY. Many of you know this. Look at the move off the lows. See the big volume? That's the first thing we want to see. Then we want to see the right side development get real tight. You got here you go. 1, 2, 3, 4, getting smaller and smaller, nice and tight in the right side, and then bang, breaks out, and now you're in the stock and you can enjoy that move. Take a look here. Central Garden and Pet, CENT. This is one nice big setup here. I mean, again, this looks like this could be so many of the other stocks we looked at. Almost identical. This right side is amazing on how it looks like so many of the previous stocks.
Yeah, and
go ahead.
On this example and the previous example, what's interesting too is that both of them pulled back. I mean, you see this went to 1972 and pulled back almost to exactly to where the buy point was. Right near where your arrow. But yeah, if you look at that pullback after the breakout, move farther over. Yeah, you're right there. Yes, same. This happened with the previous example too. Sometimes if you miss that breakout, you can buy it as it pulls back, and you can be fairly confident, especially if the stock went out on big volume, because you got that huge base under you. And so it's actually a low risk buy point when it pulls back down there, especially if it's pulling back on the light volume.
And remember, we talked about 96% of big winning stocks, leaders, come out of market corrections. Look at right here. This is the S&P 500. You see, you're in a big consolidation here, very similar to what you would see right now in the Russell 2000, where you've got that base that's been for 9-10 months now. So again, here's a stock coming out, and it's coming out just as you come up the right side, and the market hasn't even broken out yet. It's still in this long, wide, this long consolidation here, and hasn't even broken out of that basing, but this stock is coming out because it's a leader, and the leaders lead. Let's look at another one here. So this is one that, again, you see the demand here off the lows. Sometimes you'll see, if the base is large enough, you'll see a bunch of points where you get this demand coming up the right side. You get a nice run right here, right up, but you're waiting for it to get nice and tight. Now, again, you draw that line across, you can see we've actually moved above there a little bit here, right here, but you never tightened up. You got to wait for that tightening. That's the key, is to wait for that tightening, buy from that tight point. Sometimes we call it a high pivot or a high handle. You might get that tightening will happen right above the price action. And it's right here. You can see just a little bit above it. And now look how it comes out, and wham, how it takes right off. See, again, as it goes through all those contractions, just like the towel getting tightened and the water coming out, here's a whole bunch of water, little less, almost nothing now. Now, boom, it's ready to go.
Yeah, and Mark, I just to repeat almost what you said on that, your second arrow, the reason why you wouldn't buy there as it came up above the black line is because it was coming straight off the bottom. It had no tightness to it. And anytime a stock comes from the lows all the way to highs, I mean, that's a 10-point move. That's almost a 25% move from 44.57 to 54. That it has to rest as it gets to new high ground. And it tried to tighten up there for a few days, but it didn't make it. It came back in. And that third arrow is exactly where your proper buy point is.
And this is where volatility contraction comes in, where I came up with this because I was teaching other people on how to analyze charts. And I found that so many people were misinterpreting the charts and misinterpreting O'Neill's work and the cup with handle and these various price patterns. So again, on this right side here, this is too wide and it's just shooting right off the lows here. You don't have that tightness. So to be able to illustrate this is where I came up with the volatility contraction concept. And fortunately, it's really taken off and it's really helped a lot of traders better understand this. And the key is that you really want to wait for that tightness on the right side and go through those iterations of tightening. Now, you may have where in this particular case right here, this would be one right here, one decline, and then you move up and you tighten up right away. This would just be a 2. 1 and then 2. So sometimes you can get just a couple of one contraction, but 1 decline, 1 contraction, and that would be a 2T, like I said, or 2C. And then you come out from there. We'll show you that on a weekly.
And I think that those 2 arrows, or the first arrow, is important. There's that shakeout again, below trading of about 4 months, and then it quickly comes out. And almost breaks out, but then tightens up again. But that shakeout is, I think, important to mention.
Yeah, and you can see that right here on the weekly. Can I even zoom up on this? Let's see if I can. Yeah, so you can see the weekly how it undercuts the low, and on the weekly it closes right at the high. And the very next week it moves up, closes right at the high, and then look how tight. Look at those weekly bars. See how tight it gets, and then bang, it comes out. So even on the weekly chart, you're going to see. So you should always consult a weekly too. Dave, I always look at a weekly. I look at a daily and I look at the weekly. Are you always looking at the weekly as well as the daily?
Oh yeah. I mean, when I do more work into a stock, I look at it from daily, monthly, weekly, and then I even go down into 60-minute charts or 10-minute charts to absolutely time the exact spot of where I want to get in.
And that's overlapping time frames. What Dave's talking about is actually what we call stacking time frames. So if you go and you take a look, it's in a long-term uptrend. The current chart looks great on the daily. You look at the weekly looks great. You can even go down and look for these patterns, and you'll sometimes find in that intraday, like I showed you that intraday, where in that little bit of time frame, there was actually a VCP. If you want to time it right down to the hour, to the minute, sometimes you'll actually get a setup intraday that will then correspond with the breakout on the daily. But you're going to start from the larger time frames and work your way all the way down to get to that very specific moment of buying. Now, I'm just going to back up here to page 180 again, and then I'm going to flip back to page 182 and just take a look how similar the characteristics are. May not be exact, but very similar how you drift off and take out these lows a few times and then come right up the right side and tighten before you explode. Let's go back to 180 again. You see, you drift down, take out the low, come ripping back, tighten up before you explode. Same exact characteristic, just a little bit different fingerprint, of course, but same characteristics. Here's Kenneth Cole. We've looked at this before, but you'll see you've got the move up the right side here, up the right side here, and then it tightens up right down to just a couple days. And again, look at the volume on that one day, comes way, way down, and then the volume comes in at the breakout.